Last week was our first playoff game, and my plaque psoriasis was so itchy under all my gear. Sometimes just thinking about scratching could take me out of the moment. And then my doctor told me I could get clearer skin with a pill called Otezla.
Otezla apremilast is a prescription medicine used to treat adult patients with plaque psoriasis for whom phototherapy or systemic therapy is appropriate. Otezla can help you get clearer skin after just 4 months.
Okay, ready for the next game. Talking to my doctor about a pill was a total game changer.
Don't use Otezla if you're allergic to it. Get medical help right away if you have trouble breathing or swallowing, swelling of the face, lips, tongue, throat, or arms. Severe diarrhea, nausea or vomiting, depression, suicidal thoughts, or weight loss can happen. Tell your doctor if any of these occur and if you have a history of depression or suicidal thoughts. Live in the moment. Ask your doctor about Otezla. Call 1-844-4-OTEZLA or visit Otezla.com for prescribing info about cost, and more.
Reality radio for a really great future. We're talking real money.
Well, hello again, everybody. Welcome to Talking Real Money on a really, really special anniversary. This is a special anniversary we're going to celebrate today. Bet you don't even know what it is, but we'll get to that in a minute. I want to keep the suspense up here. Hi, I'm Don. Over there is Tom.
Hello.
Say hi, Tom. Hey, there's Tom.
All right.
And we're here to help you deal with money, to talk about the things that we all do with money all the time, and how we use money to improve our future, and how you invest and guess and scheme and other scheme. And, I got a story to tell you about a guy who came up to me at Chick-fil-A today. Oh, my gosh. And our number, 855-935-TALK, 855-935-8255. It's free and it's easy. So, Tom, you already know what the anniversary is.
I do.
Because I told you.
Yes, thank you. Otherwise, honestly, I would have had
You would have
absolutely
never known.
no idea.
20 years ago this week, the first fracking took place in June of 1998, the very first fracking well where they pumped sand and water down into the ground, broke apart the shale that had the oil in it, and started pumping oil and gas out, and they went, whoa, look at all the oil and gas we still have.
Because there was a lot of suggestion that fields were, kind of dry, right? That weren't going to be able to
Well,
come up
as a
anymore.
matter of fact, if anyone over the age of 20 years old is bound to remember all of the talk of peak oil. We were supposed to have reached peak production in the United States. We were out of oil in the 1970s, 1980s. It was done. There was nowhere to go but down. All of the predictions were, Saudi Arabia was going to rule the world. We had to kowtow to the Middle East and the Russians just to keep driving our cars. Eventually, we'd flat out run out of oil. And where do we stand today? How accurate were those predictions that we were going to run out of oil and the economy was going to collapse?
Not at all. I mean, we're now leading the world with over 10 million barrels a day of oil production.
That's not hyperbole. We passed in March. U.S. oil production passed that. It had already been past Saudi Arabia for a little while. It passed Russia, and the United States of America, after all of the naysaying, after all the gloom and doom, is now the largest oil-producing country in
And
the
so
world.
this
That's so ironic.
petrochemical update is brought to you by Standard Oil. I couldn't remember who paid for this spot.
I don't know which companies are still around. Exxon or somebody.
Pardon me.
I
Yes,
don't
there.
know.
There's
Yeah,
the-
nobody gave us any money.
Oh,
the
okay.
point is not really to talk about oil. I am using oil to make a point.
I was wondering. Okay, please.
There is a point, and that is that every single day, people around the world make predictions about the future of the economy of this planet. They predict whether U.S. business is going to get better or worse, whether foreign businesses are going to get better or worse, whether stocks are going to rise or fall. And the point of this is, no matter how apparent, how conventional wisdom says you can't, you absolutely have to believe this. It is happening. You can't deny it. The world is coming to an end. The fact of the matter is, it hasn't yet, And it's not very likely to in our lifetimes or the lifetimes of our children or our children's 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 children's
Okay,
children.
so what do you believe then?
That we manage to muddle through.
I see.
The human race manages to muddle through. And, gee, for as long as we've been able to track economic growth, and we can roughly track it going back to when we first became agrarian and started settling in cities about 8,000 or 9,000 years ago. And the human economy has grown consistently more valuable over thousands and thousands of years, and for us to think that we are the generation that is going to watch the end of it is...
Well, that will happen, though.
This generation?
No, everything we know will end at some point. It has to.
The estimate...
The sun goes
the estimate
away.
on that is, it's like tens of millions of years.
Okay, yeah. So it's
minimum.
I didn't say it was tomorrow. It just
Well, that's why I said as far as my life, my children's life, my grandchildren's life, my great-grandchildren's life, I think we're in pretty good shape.
okay.
I think we can continue to bet that things are going to be better in the future than they are today.
Now that's
They
saying
have
something
been.
completely different, by the way.
No, I said the economy's always grown.
Yeah.
The standard of living has consistently risen
Has it?
globally on average.
Okay, on average. Okay,
on
fair enough.
average.
Yeah.
I'm not, so for some people it's, but again, there is, and I don't have the exact number sitting in front of me, but there's a great deal of evidence to show that even the poorest people in the world are wealthier than the poorest people were 100, 200, 300, 400, 500,
and our
600
friend
years ago.
Bill Gates has spent a lot of time talking about this, about how, yes, many parts of the globe that have been very poor are not as poor and are getting better over time. So is that it? Is that it for the lesson? We're going to go into money
that's
and
the
all that
lesson,
stuff?
and now we're going to talk more specific stuff. That was the big picture. Now the little stuff's coming up. 855-935-TALK is our phone number, and of course, we want to talk with you.
Tom and Don are talking real money.
If you're sick of investing through an insurance agent or a stockbroker and you're in the market for a fee-only advisor who charges truly low fees and uses a scientific approach to building portfolios for your risk tolerance and need, you should check out Vestory. Tom and I started this firm, and it is devoted to educating everyone, total transparency, clarity, low fees, and great service. If you're looking for an advisor, you ought to at least take a look at us at Vestory.com. That's Vestory.com. Or give us a call, 800-386-3004.
For your real life and real future, Tom and Don are talking real money.
Hey there, our number again, 855-935-TALK, 855-935-8255. And if my friend and partner, Tom, seems a little distracted today.
Oh, come on now, really? You're going to do
It's because
this?
he's over there watching the World Cup
It's
in
almost,
the studio.
Yeah, okay. And Portugal just
And-
tied it up, so.
And I'm sorry, he's suffering from a bad case of busted bracket.
Yeah, I know. I already have Argentina out. Come on, first game.
He broke his bracket.
I know. Nobody else is going to know what that means unless it's the basketball thing.
Apparently, he's going to need major surgery for his bracket.
I'll be
don't
okay,
know.
as you pointed out. It's a couple $100, big deal. No big deal.
It's $20.
Oh, $20, whatever.
You're
no big deal.
exaggerating slightly.
No big deal.
And the other thing is he's a consummate gambler.
Oh, yeah, that's me. Always sneaking off to wherever I can.
Gambling on soccer games. All right, 855-935-TALK is our number. There's no gamble calling us. You're going to get the straight scoop. You're going to get
And you're
honest advice.
You're going to get the guidebook, right?
And because it's summer, we're in the bribing mood. Not only is Tom a gambler, he's a briber. And
Developing quite a reputation here.
really, the criminal element in this studio is overwhelming. We're bribing you with the relatively new, it's just a few months old, Vestory Better Retirement Guidebook.
It's people love that thing.
It's beautiful.
Yeah.
It's a beautiful piece of work.
It's got educational pieces in it.
Education.
It's got
It's
places
got
you can
your
do
education.
You
It's
can
got
write down
your-
numbers.
Number
Yeah.
places.
Yeah.
It's got them. Yeah, they're beautiful. It's got little slots to put
does.
numbers in.
Yeah.
You got to get yours. So give us a call with a question.
Okay.
855-935-TALK. 855-935-8255.
And now the other part is done, so we now know that it was darkest just before the black gold dawn. We got that figured out, right?
Thank you.
Okay.
And as a Don, I appreciate that. Now.
Yeah, go ahead.
Now, I got to tell you a story.
Please.
A story. I got to tell you a story. Ready for the story? The story goes like this. I went to Chick-fil-A for lunch today. I know that's going to surprise you. Mm-hmm. Anyway.
At your normal booth where they have your name.
At my normal booth, and they've got it's engraved, and the whole staff there knows me. And a guy, I sit down, and this guy comes running over to my booth, and he goes, I was just talking to them, and they say you're a talk show host and you give financial advice. Oh, I'm so excited. I really want to get together with you. I want to talk about some stuff. I'm in the financial business. I said, oh, great. He goes, can I get your card? I said, yeah. He goes, yeah, I'm with World Marketing Alliance.
No, really?
Yeah. And I sort of,
oh my goodness.
I smirked at him. I did. I smirked. Mm-hmm. And he goes, is that a good smile or a bad smile? I said, I'd have to put that in the bad category because I never have had anything nice to say about World Marketing Alliance. You know what?
Well, explain what it is.
Alliance.
Yeah, no, I do.
It's unbelievable. It's Amway for insurance and mutual funds.
Yeah, it's a good way to put it.
It's multi-level marketing money management. Wow, that's a lot of M's. Multi-level money market big.
They don't
whatever.
promote themselves that way either, by the way, just in case you're wondering.
No, they don't call themselves that.
No,
but let me tell you what this guy was trying to do. He was trying to get one of the employees in Chick-fil-A to come work for World Marketing Alliance and become a financial advisor.
And you called foul on the whole thing.
I didn't call foul.
Because it's Chick-fil-A, right?
The Chick-fil-A guy goes, well, no, I mean, Don McDonald over there, he's a radio host, and if I have any financial stuff, I just talk to him.
He's in booth 3.
The guy runs over. Yeah. And I said, I'm not going to say anything nice. So I gave him the website, and now my wife's worried that he's going to come after.
Oh, he'll find you and be by. Wow.
I hate World Marketing Alliance.
But explain why.
Well, because what it is, it's much like any other multi-level marketing deal. One, they I could start with, they sell very expensive loaded mutual funds by people who haven't a clue what they're doing. I mean, they really are not financial professionals. They have been in trouble with regulators. I mean, all you have to do is look them up online. Just look up World Marketing Alliance. They've been in trouble with regulators not just here, but all over the world. Canada, etc. And what they do, instead of selling you something, the way they make their money is by convincing you to work under them as another advisor who's out there promoting the business to new people. It's all about bringing in bodies to help fund the upstream or the.
Yeah, I'm not a huge fan of multi-level stuff. I mean, there was a piece on American Greed about Telex. Anyway,
that's what Tom watches when there's no soccer.
He watches that World War II or no
money sport, blood sport. It is. It's all sporting.
All right.
So anyway, it was just funny, and so if
you didn't sign up, then I take it.
You're right.
Okay.
855-935-TALK is our phone number, 855-935-8255.
Let's go to the phones. Chuck joins us here on Talking Real Money. Hi, Chuck.
Hi. You guys are very capable.
Thank you. That's very kind.
It's wait, capable.
Yeah, that's kind of a...
That's one of those backhanded compliments.
Kind of weak, Chuck.
You people are interesting.
Go ahead.
You opened the program talking about oil.
Yeah.
And I just have a question for you. You talked about fracking. It's been 20 years. When they first started using oil, they called it a fossil fuel, correct?
Yes. Well,
I guess. I don't know when they first started using it. I don't even think they knew what the heck it was. It was just this black gooey stuff that burned and came out of the ground.
True. They made kerosene and other things.
Right. Kerosene.
Yeah. Mm-hmm. Yeah.
And it was a plague to a lot of the farmers and the rest of it until they figured out what it was. My question is for you guys is that they call it a fossil fuel because they're stating that the strata of all of the peat and the bones and so forth, the dinosaurs, are what create oil.
Well, actually, it was mainly the plant life.
Yeah.
That's
vegetation.
Go ahead.
That too.
Yeah.
But they're drilling way past that strata now, and they're still getting oil.
No, but because
they're breaking up the stuff there, right? No?
Yeah, they're breaking up stuff they've drilled into before, and they are drilling way down because we've had plant life on the planet.
That the plant life and whatever else, what they're calling a fossil fuel, exists below strata.
I'm gonna let Don take this one.
Given my limited I loved geology as a topic, and I'm fascinated by it, and
he's been called a fossil too. So,
and I've been called a fossil. As plants died millions and millions and millions, hundreds of millions of years ago, they piled up at the bottom of oceans. The pressure from the ocean squished them down. Then dirt came on top of that, and then more plant life, and then dirt and plant life. And it built up miles and miles and miles and miles thick. And so we could drill down for a long way and still hit old pockets of multi-billion-year-old squished plant life rock, basically.
Tom and Don are talking real money.
We mention 855-935-TALK, 855-935-8255 throughout the podcast. But you need to know that you can call that number 24 hours a day, 7 days a week. Leave your question, and those will be answered in special Talking Real Money podcasts that will appear on this particular site in the future. So give us a call, 855-935-TALK, 855-935-8255.
Your guides to a really great financial future. Tom and Don are talking real money.
Welcome back to Talking Real Geology. I'm Don, your professor.
Couple of old fossils here to help you out however we can.
That was just a quick down and dirty geology lesson.
Well, you started down that well, and we can barely pull ourselves back out.
So
I'll tell you what. Yeah, okay.
I'll keep pumping for as long as I can.
Exactly. Hit the
till
gusher.
I pump it dry.
There you go.
Yeah. Eventually, if you drill deep enough, he's right. You're going to run out of fossil fuels, and then what you'll do is you'll hit magma, which could actually fuel a lot of stuff. It's really hot.
Maybe they figure out how to tap that. That'd run your
tap and magma.
Whatever.
They do that in Iceland. It's a big thing. 855-935-TALK is our number. We're bribing you with a book, the Vestry Better Retirement Guide book. Get yours free with a call to the show at 855-935-TALK.
And it's a great piece. It really is. It's we gave it out at retirement. We gave it out the other night at Retirement Freedom. So, one of the things that comes up a lot, too, because the half a year is basically over, right? Because the first of July
half a year already
coming up here pretty quick.
I am a fossil. It's like it feels like time is
another
flying.
Half a year, yes. So a lot of people ask us, well, okay, so how did it go in the first half of the year? And the answer is
I don't
not
care.
very
That's
well.
my answer. I don't care.
For full disclosure, I do my spreadsheet twice a year. So I take the values and I put them in the spreadsheet, add it all up. And yes, my house has gone up a lot in the last year, as you may expect.
Because you live in the Seattle area.
Exactly. But the stocks and bonds and stuff have not had a great half of the year. The 100% stock portfolio, I love this. The increase for the first half of the year?
Yeah.
0.06.
Well, that's better than 0.00.
That's a good point. S&P 500, which many of you are invested in, that made 2.7. But here's where you're probably not invested. Small company stocks up 5.3. U.S. small value stocks up 3.7. And here's where you're really not invested. And you're probably glad because emerging markets, Brazil, Russia, India, China, Don, I know places you love to invest, down 7.5%. International small companies down 2.3%. Stuff like that. And bonds didn't make you any money either.
People don't want to invest in those things when they're down, which is
This is the
wrong.
This is the part that I love from Jason Zweig's piece today.
Right.
It's fascinating. Go ahead.
People don't like investing in things that are down, and that's exactly the opposite way you should be thinking.
And we'll take that up in just a moment. Let's go back to the phones before we have to go to the bottom of the hour. We'll tell you why in a minute.
Really? All right.
All right. We got time. Squeeze one in.
No, we don't.
Tom,
okay, but
how are you?
Go.
I'm very well, sir.
Good.
Thank you for my call.
You bet.
I have a question. I'm getting on to 80 years of age, and I was talking with my son, who's an engineer kind of a guy, and he said the balance of stocks to bonds should be 80-20 in my age category. Is
80% in bonds, 20% in stocks?
No,
80% in stocks?
Oh, no, 80% in bonds, I'm
Okay.
sorry, and only 20% in stocks. But I'm kind of thinking that bonds are very safe but not making any money where stocks could. So what would be a better percentage?
You know, that's one of those. Just subtract your age from 100 and you get enough. I don't buy into that.
That's the simplistic answer.
Yeah, I don't buy that. I mean, so is this money you're living on today?
Well, yes, I have a house that's paid for. It's worth like $750,000 or so if I were to sell it, and then I've got about $350,000 in investments through an advisor, which I won't. Name, so
the correct. Let me just the correct answer to this question is it depends on the person. It really, truly depends on you. And what I would suggest, it's not age-based, it's inclination-based. Go to Vestory.com, take the risk quiz. That is going to give you a really good idea of what your allocation should be. And then remember, you don't own bonds in your portfolio for the return. You own them in your portfolio for the reduction of volatility they provide.
Tom and Don are talking real money.
In addition to the Talking Real Money podcast, I also do another podcast that's very popular over at Apple Podcasts. It's called Money 30. Every day I try to educate and inform you about money in a brief 2 to 4 minute podcast. So check them out at Apple Podcasts or all the other podcast services or at money30.com.
Reality radio for a really great future. We're talking real money.
Talking Real Money, the summer edition with a little bit of a bribe thrown in on the side. 855-935-TALK is the number. 855-935-8255. You can get yourself on track for a better retirement with a free Better Retirement Guidebook if you call the show.
And we mentioned a couple of minutes ago that around. Well, I want to continue on the bond topic at some point because I think that's important, right?
Okay.
We're very quick.
It's our show. We can pretty much do whatever we want.
That's very kind. I mean, the reality is but I can guarantee you here's what's going to happen, because this is from Jason Zweig's article too, that when people get their statements in the next few weeks from the half a year, they're going to say, why am I in those bonds? Because look at this bond fund. It lost, I just looked it up, intermediate government bond fund lost a whopping 1.6% in the first 6 months of the year.
Why am I in the stuff that's going down?
Yeah, that doesn't make sense. And if you feel bad about that, then we can talk about all the international stuff that, hey, why am I in those funds?
Why am I in that international stuff? It didn't do well.
It did poorly.
Why am I not in the stuff that I love this.
Here you go.
Why am I not in the stuff that's going up?
Yeah, which is a bit of a problem because you should always talk about financial matters in the past tense. Same thing true of the housing market too, by the way. The housing market is not going up. It's gone up. It may start going down tomorrow.
That's not what they're saying in the Seattle area. Houses are going up.
But Jason Zweig had a great piece today. You want to read about the real nuts and bolts of this business, because everybody, Don, as you know, has an advertisement about how much their strategy made or their fund made or whatever. They don't talk about is how much the investors that invested in their fund make, because most people make far less than the mutual fund. Why is that? Well, because you all have a poor track record of buying things after they've gone up and a worse track record of selling them after they've gone down. And Jason's piece today was informative in that apparently you're all doing better, but we'll talk about international at the end of this. So, I mean, the numbers were interesting, Don, because it looks like investor behavior, at least according to this study, I think from Morningstar, is improving, correct?
Yeah. absolutely. Just recently. But it's not.
That was my toss to you, just in case.
Was that a toss to me? I mean, it was a very slight increase, but overall, though, still investors are doing worse than the funds themselves.
Well, that's true,
and that's really the point. Whether it's improved somewhat, and it had one of the reasons why, and he kind of alluded to it, but he didn't get into the nitty gritty of it. One of the biggest reasons why the investor return improved recently is because, well, one, lack of a great deal of volatility. It hasn't been horribly volatile. We haven't had a big upswinging market or a big downturning market. It's just been kind of laying around. I mean, it goes up and down a lot day to day, but generally it's, as you said earlier, it's at 0.06% up.
Yeah, 0.06, yeah.
0.06. It's hardly moving.
Yeah.
And for that reason, people aren't panicking.
Well, almost those. He points out, as much. He points out at the end of the article, guess where money's been coming out of lately?
Oh, probably international.
Yeah, right. People have been selling their international funds because those are going down. I don't want to stay in anything that's going down, right? I mean, it's so that behavior is poor. In other words, you should have an asset allocation. You should have a strategy around what type of stocks to own. And as we talked to Tom about a minute ago, how much of your money's in riskier things like stocks and less risky things like bonds.
Well, and we had, just to talk about the longer term issue of investor return and bad investor behavior, the more eclectic an asset class gets, the more complicated it gets, the more likely people are, and the more volatile it gets, the more likely they are to cut and run. And you had a slide in the presentation that you did on Thursday, with
about
Rick,
emerging markets,
comparing two emerging markets funds, a very volatile segment of the market, and the Fidelity Emerging Markets Fund, which is one of the best, by the way. It's a great fund, and the fund over the past 15 years has returned about 11% per year. That is a great average annual return.
You bet it is.
But because people do dumb stuff like panic when it's going down and get excited when it's going up, gone down.
Thank you.
The investor return, the average annual investor return for that fund is 5.41%.
Now listen to those two numbers again. What was the return of the fund?
10.76%.
And what people actually made was
5.41. That's half.
Shocking.
That's terrible. Yet a fund in the same market that is offered through investment advisors who are going to keep you invested only had a slightly lower investor return, 11 to 10%, a 10% decline instead of a 50% decline. We'll be back talking real money.
Tom and Don are talking real money.
If you need help allocating your retirement plan at work, you can get free help at 401-411.com. That's 401-411.com.
For your real life and real future, Tom and Don are talking real money.
855-935 TALK 855-935-TALK. You get a free copy of the Better Retirement Guide book that helps you chart your course to a brighter future. Absolutely free if you call and ask a question on the air.
Let me finish the thought, too, about what type of stocks own, what kind of bonds don't, all that, because it's very important. The reality is we don't know what the best mix of all that will be for the next 20 or 30 years. We don't know.
Nope.
We have no idea.
How would we know that?
Right. How would we know that? But we do know that being diversified and taking an appropriate amount of risk over time
for your risk tolerance
should get you to where you want to go. That said, what you don't do is react exactly what we were trying to tell you. This is the point I'm trying to finalize. You don't react to whatever's going on, the fracking or not. You don't jump into the oil stocks. You don't react to the tariffs and all the rest of it. You don't react to a first half of the year where international stocks have gotten bruised, other than, by the way, buying more international stocks. That would be the only thing you would do. So, does that make sense?
And that's what, but it's to make yourself do this while psychologically difficult. It's very difficult, is actually technically quite easy.
That's true.
The way you do it technically is you make yourself sell some of your winners and buy your losers in a process called rebalancing.
It is counterintuitive, and many people just can't do it, and that's
painful.
why they hire an advisor to do it for them.
Yeah, it's like right now, if your portfolio is like most portfolios, even though your stocks haven't done really, really well over the past 6 months, you might and should be probably selling a little bit of stock and buying those underperforming awful bonds.
Yeah,
or selling a little U.S. and buying international.
Tom alluded to this too a bit, that I'm afraid of bonds. We've talked about this on the show for much of this year because interest rates have gone up, bond prices have gone down. Bonds, if used properly, short and intermediate term U.S. government debt, again, in funds where you're buying new bonds at higher prices, over time, we would expect those prices to be relatively stable. If you're going way out and trying to buy 30-year bonds, you're buying troubled corporate debt, you can expect volatility because that has occurred.
Yeah, but those are high risk.
Yeah, and that's people trying to get more yield, right? Trying to make more interest. That has been problematic.
Called stretching for yield, and it is a risky proposition. 855-935-TALK is our number, and Glenn both gets to ask a question and gets a book.
Wow, this is a big day for you, Glenn. Glenn, how are you?
I'm doing fine. My question is, I don't seem to be able to find any information about the state guarantee funds, like you get an immediate annuity, and there's some protection. I realize, you obviously check out the company you're getting it with, but, if you're going to have that thing for 20 years, who knows what happens to the company.
Are you a state employee?
And so, no. I'm just talking about, through an insurance company getting an immediate annuity kind of a thing.
Oh, annuities.
And they have those state guarantee funds.
The state pools,
I can find out, the total, the total that you can protect is $500,000, the present value. But I can't find any specifics. And I realize I've read before that what happens is they usually try to basically get a solvent company to take over the contract when a company fails.
That's generally happened, yes.
But the thing that I don't understand, if you buy it in Washington, can you leave the state? Is it still covered by Washington, or is it then covered by the state that you move to? So, like, if it's $500,000 in Washington and $200,000 in a different state, do you suddenly lose that protection? And things like, if you buy a contract with, that say goes up 2% a year, inflation protection or something like that, are those contract provisions preserved, or is the contract basically voided and you get something back but not? In other words, is there someplace you can go? Because it seems like
no. If you're asking for a central clearinghouse where you can check out the level of risk for your annuity, no.
I don't know of it. Yeah.
No. And let me tell you, what you have talked about, what you have alluded to, has happened in the past. There was a company in California called Executive Life, and didn't matter where because they were based in California, you were covered by their pools there, but there wasn't enough money when they went bankrupt. And they couldn't get enough companies to step in and pick up the tab. So what Executive Life was investing in junk bonds. And what happened is Executive Life's policyholders I haven't looked at it lately, but up until a few years ago, we're still getting paid off from 1991.
Is that helpful?
These things are, I got to tell you, annuities are, the lovely thing for the insurance companies is that they're allowed to say they're guaranteed, but the guarantee is not even close to the full faith and credit guarantee provided by treasuries or FDIC insured accounts. It isn't even close. There is not enough money in the state pools. There is not. In the case of a gigantic economic disaster, I can guarantee you that annuity holders are going to lose money.
We
in a
almost
huge
saw
disaster.
it, right, in 2008.
AIG nearly went away.
Yeah, right.
And that if the government didn't bail them out, which at some point, if you have enough of the big AIGs going out of business, the feds aren't going to be able to bail them all out. And AIG's bailout alone would have been $150 billion. These are not safe. You cannot believe that they are absolutely, ain't no doubt about it, safe like you can with a government security. That's the reality of it. I don't, you want to look for the highest rated insurance companies you can find. You want to look at the company's balance sheet, and you can get hold of that. It's just hard to read. You want to make sure they don't own a lot of low-quality debt, that they don't own a lot of individual corporate stocks. But to know that you're going to be safe for sure, that's why you get these higher returns. That's why you get it's a trade-off.
The only thing that we know we can say has been always there so far, U.S. government debt.
Well, and the thing about U.S. government debt is that the insurance companies and the states do not have the ability to raise taxes to cover the shortfalls of those funds. The U.S. government does. That's its huge advantage over all of these other securities. And this is the lesson that I think everybody who listens to this show needs to absolutely learn. There's nothing out there that's free. If a return is higher on a product that somebody is pitching you than a government bond that's absolutely safe, then I guarantee you the risk is higher.
It has to be.
It has to be.
Yeah.
The market is very efficient.
Yeah, indeed. And this is the part of investing that is really at the crux of the matter that people don't think through often when they do get into some investment or they hear a proposal or you want to find that thing that is going to make you rich without any risk. I don't know of it.
And yet there are plenty of people out there who are willing to tell you that such a thing exists. I just read a story recently of a stockbroker who was selling people non-publicly traded REITs and structured notes, senior citizens, telling them that they were absolutely safe and that they could get 5 to 8% average annual returns, and they were a great substitute for their CDs. Well, it turned out they weren't. That's kind of the way it works.
Bad news.
I know. It stinks. You got to be careful.
Tom and Don are talking real money.
Keeping the podcast breaks as painless as possible is my goal. That's why I want to very quickly tell you about the only magazine I've ever heard of that is 100% real investing all the time. There's no business news, no speculative advice, and certainly no lifestyle stuff. It's called Real Investing Journal. I publish it every quarter, and you can get 2 full years for only $25 at realinvestingjournal.com. That's realinvestingjournal.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Generally speaking, and of course we have to speak generally, women are less comfortable dealing with their finances than men are. Now, that's something that needs to change, and a lot of you have asked us to do a class specific to the financial situation that women face. And we're doing just that on July 14th. Our own Barb Devereaux has created a new class called Female Financial Fundamentals. You get muffins and an education. Just go to TalkingRealMoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?